Welcome, curious learners, to another deep dive.
Great to be here.
Today, we're plunging into the fascinating world of semiconductors. Specifically, we're taking a really comprehensive look at NXP Semiconductors N.V.
That's ticker NXPI on the NASDAQ.
Exactly. And the big question we're trying to unpack is NXP this critical picks and shovels provider set for the future? Or maybe are its current strengths hiding some vulnerabilities in, well, a pretty fast-changing tech and geopolitical landscape?
Mm-hmm.
That's what we're here to figure out for you. And hey, before we dive in, just a quick reminder, do like and subscribe to the stockanalytics.ai YouTube channel.
Yeah, definitely helps us out.
It does. And members paying €4.99 a month get priority deep dives on the tickers they suggest in the comments. So stick around to the end because we've got a final thought that might just shift how you view NXP.
Right. So our mission today is pretty clear. We're doing a thorough analysis, looking through that lens of long-term, value-oriented investing.
The fundamentals.
Exactly. The quality of the business, the management team, and really rigorously assessing its intrinsic value. And all this is based on data as of June 19th, 2025. NXPI closed at $211.45 that day.
Okay, good context. We've split this deep dive into two main parts. First up, chapters 1 through 3. That's the business itself, management, and the core financials.
The foundations.
Then in part 2, we'll shift gears to chapters 4 through 7. That covers market sentiment, who owns the stock, the risks, and our overall conclusion. It's going to be packed, I think.
Definitely a lot to cover.
Okay, let's unpack this, starting with chapter 1, business analysis. So NXP's core business. It's built on what, over 7 decades of innovation in semiconductors?
That's right, a long history. And they don't just sell chips. They focus on providing complete system-level solutions.
That brighter together approach they talk about?
Precisely. It combines their hardware with sophisticated, often proprietary software. This creates these platforms that help customers, particularly in complex regulated markets, speed up their own development.
Which builds deep relationships and, I guess, pretty significant barriers to competitors.
Exactly. It makes them sticky. Now, what's fascinating here is how they've diversified revenue. Fiscal year 2024 data shows 4 main end markets.
And automotive is the big one, right?
Huge. A staggering 56.7% of total revenue. So, their fortunes are really tied to what's happening in cars, ADs, EVs, all that tech evolution.
That's a pretty concentrated bet. High risk, high reward, maybe.
Could be, especially considering the 4% year-over-year decline in automotive revenue in FY 2024, which highlights that concentration risk. The other segments are industrial and IoT at 18%, mobile at 11.9%, and communication infrastructure and other making up the rest, about 13.4%.
Okay. And beyond products, they also license their IP, right? It's smaller, but still notable.
Yeah, $127 million in 2023. It's a smart way to monetize their huge patent portfolio. But looking globally, Oz, what stands out is both opportunity and, well, significant risk.
It has to be China, doesn't it?
Absolutely. Massive influence. $4.56 billion in revenue last reported year, up slightly. It's a huge growth market, definitely. But also, as we'll get into, a material geopolitical risk given, current tensions.
Right. And their product range, you said it's vast.
Over 2,300 active listings.
Ah.
They really enable systems to, as they say, sense, think, connect, and act.
So that includes processors, microcontrollers, the brains of the operation.
Yep. ARM-based cores, the IMX S32 families, those are key. They power complex systems in everything from cars to factory robots.
So incredibly broad. And beyond processors, you have automotive-specific stuff like radar, secure car access.
Critical for EVs, ADS, software-defined vehicles. Yeah.
Plus connectivity like NFC and UWB.
Ultra-wideband, right. Very precise short-range radio, great for secure keyless entry, things like that. And then robust security chips, authentication, and analog and mixed signal products like PMICs, power management ICs, and various sensors.
It lets them offer those comprehensive system solutions. That feels like a big differentiator.
It really is. And in terms of scale, NXP is a large cap leader. Market cap around $54.6 billion. Operations worldwide, over 33,000 employees.
And market share leaders in automotive semis.
Yep, 13.7%. Plus leadership in NFC and UWB. Their core value proposition, that brighter together idea, it's all about making the connected world better, safer, and more secure.
So they deliver these purpose-built, tested, functionally safe platforms, hardware plus software.
Exactly. And that helps customers in tough industries like automotive cut down their R&D, manage risks, and get products out faster. It makes NXP a strategic partner, not just, another supplier.
Okay, let's shift to the industry analysis. The whole semiconductor industry, it's heading towards $1 trillion by 2030.
That's the projection. Around $697 billion in 2025, growing at about 7.5% CAGR.
And the key drivers are?
Well, generative AI is huge. Its chip market is exploding, especially at the edge. Then you've got the sheer growth in automotive and IoT, more and more electronics and EVs, ADS, smart devices, and advanced packaging trends like chiplets are pushing innovation too.
But it's not all smooth sailing, right? There are challenges.
Definitely. For NXP, there's a global talent shortage. Finding skilled chip designers is tough, an aging workforce in some areas, and increasing regulatory pressure around sustainable manufacturing adds complexity.
And competition? Fierce, I assume?
Oh, yeah. Direct competitors like Texas Instruments, Analog Devices, STMicro, Infineon. Then broader competition from NVIDIA, Qualcomm, AMD.
But NXT has carved out its niche.
I think so. Right at that intersection of automotive security and connectivity. They focus on those complete, functionally safe, highly secure systems for really high-stakes applications. It's kind of a different battlefield they're playing on.
Makes sense. And the regulatory environment must be intense.
Incredibly stringent. You've got cybersecurity standards like ISO 21434, functional safety standards, environmental regs like ISO 14001, and then the whole geopolitical layer, export controls, tariffs, especially with their China exposure. It's complex.
And barriers to entry, still sky high.
Absolutely. Extreme capital needs billions for a fab, hundreds of millions for key equipment like EUV machines. Massive R&D, huge IP portfolios like NXP's 9,000-plus patents. Plus economies of scale, the tech complexity, and those deep customer relationships, which lead to really high switching costs.
Okay, let's talk about that competitive advantage. Their brand seems pretty strong.
Formidable. Built on 70-plus years of history. Philips and Motorola roots. Reputation for quality, reliability. Validated by awards like Clarivate, Top 100, Global Innovator, and Great Place to Work certs.
And they must have cost advantages from scale.
Definitely. Over $12 billion in revenue lets them buy in bulk, run high-volume production, spread those fixed fab costs, leads to strong gross margins, 56.2% PTM. They even use their own RFID tech internally to boost efficiency.
But the real kicker, you said, is the switching costs.
Yeah, this is where it gets really interesting. It's arguably their most powerful advantage, the whole design and nature, especially in automotive.
Takes a long time, lots of engineering hours.
It's exactly 18 to 36 months, thousands of hours, often custom solutions, like 67% for auto. So once an NXP chip is designed in, switching is, well, it's virtually impossible. The cost, the time, the risk of redesign and recertification, especially with safety standards like ASIL automotive safety integrity levels.
Wow. That creates a very sticky customer base, like an annuity.
Precisely. Reliable revenue for years.
That is a huge moat. And it's bolstered by unique assets like that IP portfolio, the domain knowledge.
Right. Over 9,000 patents, deep understanding of automotive safety, cybersecurity, their system integration capability like the S32 platform, and a massive global sales and tech support team, thousands of engineers helping customers.
Okay, quite a picture of the business.
Let's move on to Chapter 2, Management Evaluation.
Right, the leadership. Outgoing CEO Kurt Sievers, he's retiring end of 2025. Seems like he provided stability.
Yeah, he did. He navigated COVID, kept factories open, shifted strategy effectively away from mobile modems towards auto and industrial, generally seen as providing steady strategic direction.
And the transition to Rafael Sotomayor seems planned.
Very much so. He became president in April 25, takes over as CEO in October. It looks like a well-orchestrated handover to ensure continuity.
But still, a leadership change always brings some uncertainty, right? Especially in what they call challenging market conditions.
True. There's always execution risk with a new CEO, no matter how smooth the plan looks on paper.
And how about transparency and ethics?
Seems strong. They communicate openly about challenges like tariffs. They have a solid code of conduct, an ethics program with a speak-up system that seems active. They reported substantiating 64% of 143 reports in 2024.
Okay, so the system seems to be working.
And internal surveys back that up. Their 2024 culture survey showed ethics as a key strength, actually exceeding tech sector benchmarks.
Good sign. Now, capital allocation. How do they deploy their cash?
Disciplined is the word that comes to mind. They prioritize R&D in their core areas, auto and industrial. And their M&A isn't about getting bigger for its own sake. It's targeted what you might call moat deepening.
Got exact.
Sure. T-Take Auto, acquired June 2025, strengthens their hand in safety systems for software-defined vehicles. Kinara, February 2025 for $307 million, that boosts their edge AI capabilities. Back in 2019, they bought Marvell's wireless assets for Wi-Fi and Bluetooth.
So these acquisitions all reinforce those competitive advantages, raise the switching costs further,
Exactly. It's a consistent playbook.
and shareholder returns, buybacks,
Here's
dividends.
strong, very consistent. Q4 2024, they returned $713 million. That was actually 244% of their non-GAAP free cash flow in that quarter through dividends and buybacks.
Wow, 244%.
Yeah, shows commitment. Trailing 12 months, it was $2.4 billion returned, about 115% of non-GAAP FCF. They've been actively reducing the share count.
Okay. And return on invested capital, ROIC, how does that look?
That's a really important metric. As of June 2025, their ROIC is 13.94%. That's comfortably above their estimated cost of capital, the WACC, which is around 11.36%.
So they're creating economic value.
Correct. And their three-year average ROIC of 15.3% is significantly higher than the industry average, showing consistently superior capital allocation.
Okay, impressive. Now for the numbers. Let's dive into Chapter 3, Financial Analysis.
All right. Snapshot as of June 19th, 2025, market cap around $54.58 billion. Trailing 12-month, or TTM, revenue is $12.32 billion. And diluted UPS, TTM, is $9.18.
And revenue growth over the last 5 years, you mentioned cyclicality earlier.
Yeah, you can really see it. Overall, a 7.3% compound annual growth rate, which is solid.
Well,
But there was that big surge in 2021, 2022 during the chip shortage, followed by a slowdown and even contraction in 2023, 2024 as inventory normalized.
so definitely reflects the industry cycle.
Clearly. But the long-term trend is still positive.
How about profit margins? Gross, operating, net.
Very strong. Gross margin TTM is 56.2%. Operating margin TTM, 27.6%. Net profit margin TTM, 19.2%.
That operating margin expansion is striking, isn't it? From low single digits a few years ago.
It really is. Up from 7.2% in 2019 to over 27% now. Shows excellent operational control and, frankly, pricing power from those strong market positions.
And free cash flow. Consistent generator.
Absolutely. A powerhouse, averaging over $2 billion annually for the last 5 years. Consistently strong, even through downturns. This is what funds the R&D, the acquisitions, and those shareholder returns we talked about.
Okay, let's talk financial stability, earnings consistency.
Positive long-term trend, despite that volatility. FY 2024 GAAP diluted EPS was $9.73, down a bit from 2023. But the 5-year EPS growth is actually 61%, albeit from a low starting point. And analysts are projecting around 13.7% EPS growth over the next 5 years.
Debt levels, debt to equity.
The ratio is around 1.21 or 121.2%. It has fluctuated, peaked higher back in 2021. But their ability to service the debt looks strong. Net debt to equity is lower, about 80%. Interest coverage is very healthy at 13.4 times operating income.
So manageable. And short-term liquidity, current ratio.
Solid at 2.08. Means they have plenty of resources to cover immediate obligations. Pretty consistent with their long-term average, too.
And the dividend, stable, growing.
Very much so. Paid for 7 straight years, no cuts in the last 5. Current annual dividend is $4.06 per share, giving a yield of about 1.92%.
And the growth has been impressive.
Yeah, really strong, 22% CAGR since 2018. The payout ratio is sustainable, around 41-44% of earnings, so there's definitely room for future increases.
Okay, solid financials overall despite the cycle. Now, valuation analysis. How does it look compared to peers or its own history? PE ratio.
Right, the current TTM PE is 23.0. That's way below its 10-year average of 57.6.
Yeah, big difference.
Yeah, and it also looks favorable compared to peers. NXP's is 22.6x versus a peer average of 36x, the broader industry at 27x. It suggests, potential undervaluation because the market might be overly focused on these near-term cyclical headwinds.
Okay, so relative valuation looks potentially attractive. But for a long-term investor, the key is intrinsic value, right? What the business is really worth. How do we estimate that?
That's where we use tools like a discounted cash flow or DCF model. It's an educational tool, of course, but the idea is to project future free cash flows, estimate a terminal value, and then discount it all back to today's value using a discount rate, the WACC.
So what did our educational model suggest for NXP?
Our model points to an estimated intrinsic value range of roughly $240 to $275 per share.
Okay, $240 to $275. How does that compare to analyst targets?
It aligns pretty well. Analyst consensus is around $234, $238, though some estimates go higher, even towards $300. So our range is kind of in that ballpark, maybe slightly more optimistic at the high end.
And the key assumptions driving that DCF range?
We started with revenue growth around 7%, but tempered it initially because of the current slowdown, then assumed it declines over time. a terminal growth rate of 2.75%, which is reasonable long-term, a discount rate, that WACC, of 11.36%, and projecting free cash flow margins to stay strong, around 19–20%.
Okay, that gives us a framework for value. Let's move into part 2 now, starting with Chapter 4, Market Sentiment.
Right. So what's the street saying? Analyst consensus is a strong buy. The average brokerage recommendation, or ABR, is 1.44 based on 27 firms. 20 of those are strong buys.
And the average price target?
Average one-year target is $235.63. That suggests about 11% potential upside from the current price of $211.45.
But you mentioned a wide range earlier.
Yeah, that's the interesting part. Targets range from $170 all the way up past $300 in some cases. It really reflects the uncertainty out there, the macro picture, the industry cycle, that CEO transition we discussed.
So a mix of caution and long-term optimism.
Exactly. But recent analyst actions have generally leaned positive, maybe suggesting a growing belief in the longer-term story despite the near-term noise.
And the general media tone, news flow.
I'd call it neutral to cautiously bullish. Q1 earnings got a mixed reaction. Revenue was down year-over-year, guidance was cautious. But the smooth CEO transition plan helped, and the strategic acquisitions are seen as positives for the long run. Plus, the capital returns always get a positive mention.
So it feels like a wait-and-see kind of sentiment, balancing the current cyclical pain against that long-term secular growth story.
I think that captures it well.
Okay, market indicators, short interest.
Pretty low, actually. 2.26% of the float as of late May 2025. That's down quite a bit from earlier in the year, suggesting bearish sentiment has waned somewhat.
And the price versus key moving averages, 50-day.
The current price, $211.45, is comfortably above the 50-day moving average, which sits around $191, $195. That usually indicates bullish, short to medium-term momentum.
Okay. What about the longer-term 200-day moving average?
That's where it gets interesting. The price is hovering right around the 200-day SMA, which is somewhere between, say, $205 and $215.
This is a major long-term inflection point.
Exactly. A decisive break above or below this level could really signal the next major trend for the stock. It's a key level to watch.
Got it. All right, next up, Chapter 5, ownership structure. Who owns NXPI?
Well, institutional ownership is very high, somewhere between 67% and over 90%, depending on the source.
So mostly big funds.
Yeah. Top holders are the usual suspects: FMR, LLC, Fidelity, JP Morgan, BlackRock, Vanguard, Wellington. The top 10 institutions control over 40% of the company.
What does that tell us?
It suggests stability? Maybe. It's a core holding in many index funds and industry-focused funds.
Okay, but contrast that with insider holdings. Are the executives heavily invested?
Actually, no. Insider holdings are very small, like 0.13% to 0.54%. Tiny.
And recent transactions, buying or selling.
This is a crucial counterpoint. Over the last 3 months, insiders made 10 sell transactions and zero, absolutely zero, open market buys.
Zero buys.
Zero. Now look, a lot of insider selling is pre-planned, related to compensation, stock options, taxes.
Sure, standard stuff.
Right. But the complete absence of any discretionary open market buys, that's noteworthy. It might suggest that insiders, the people who know the company best, don't see the stock as significantly undervalued right now.
That's a definite point of caution for potential investors.
It is. And that high institutional concentration, while providing stability, also means if a few big funds decide to sell or reallocate, it could put significant pressure on the stock price.
Okay, good points on ownership. Now, let's talk about what keeps folks up at night. This is Chapter 6, Risk Assessment.
All right, let's break it down with a SWOT analysis, starting with strengths, the internal positives.
We've covered a lot of these dominant market positions, especially automotive.
Right, that 13.7% share, the wide economic moat from high switching costs and design ins, the valuable IP, over 9,000 patents, powerful, consistent free cash flow generation.
And the disciplined capital allocation, high ROIC, experienced management.
Exactly. All core strengths.
Okay, now weaknesses, internal limitations. The big one seems to be revenue concentration.
Definitely. Over 56% from automotive makes them very vulnerable to cycles in that specific industry.
And some segments are underperforming.
Yeah, mobile and communications infrastructure have seen pretty high double-digit declines recently. That points to areas needing strategic attention or perhaps divestment down the line.
Any other weaknesses? Balance sheet, M&A.
Well, the balance sheet shows long-term liabilities aren't fully covered by short-term assets, which requires ongoing prudent management. And M&A, while strategic, always brings integration lag and execution risk, which can be a short-term drag.
Makes sense. Now for the upside. Opportunities, future potential.
Huge opportunities. Secular growth in automotive continues. EVs, ADS, SDVs all need more chips. Industrial and IoT expansion driven by Industry 4.0 and connected devices.
Plus new tech adoption, UWB, NFC.
Right, things like keyless entry systems. And growth at the intelligent edge using AI in devices, which the Kinara acquisition targets. Lots of tailwinds.
Okay, but then there are the threats. General external challenges first.
Intense competition, we mentioned TXN, ADI, etc. The inherent industry cyclicality, boom and bust cycles, inventory corrections. Supply chain vulnerability is always there, especially with concentration in East Asia.
Cybersecurity risks, talent shortages.
All significant ongoing threats for any semiconductor company.
And then there are the macroeconomic factors, inflation, interest rates.
Big ones. Inflation raises costs, potentially squeezes margins. Higher interest rates increase their cost of capital, which lowers DCF valuations, and directly increases the interest expense on their $11.7 billion debt load. Even recent loans carry higher rates now.
Okay, and finally, the geopolitical factors. You flagged the U.S. tariffs of 2025 as potentially the biggest threat.
Yes, this looks like the most significant material threat right now. There's a potential direct impact. A 25% tariff on semiconductors could mean maybe a 5% price hike passed on, plus supply chain disruptions.
And indirect effects, demand destruction.
Right. If tariffs slow down the U.S. economy, say by 0.6% GDP, as some models suggest, that means less spending by consumers and businesses. Some analyses suggest this could knock 10–20% off NXP's fair value, maybe a $2 billion revenue hit.
And their China exposure makes it worse.
Absolutely. That $4.56 billion in China revenue is vulnerable to U.S.-China tensions, potential retaliatory tariffs, export restrictions. It's a tightrope walk. And there's this strategic paradox, too. Tariffs designed to help U.S. manufacturing also increase the cost of building those domestic fabs, potentially undermining things like the CHIPS Act.
Wow. Okay, that's a lot to weigh.
Definitely. Which brings us to our final thoughts, Chapter 7, Conclusion.
Let's synthesize. First, summarize the key bullish points, the bull case.
Okay, you've got a high-quality, wide-moat business. They're in secular growth markets, particularly automotive and industrial. Dominant positions, high switching costs, tons of IP, deep expertise.
Powerful free cash flow generator, disciplined capital allocation, high ROIC, strong shareholder returns.
Right. And based on our analysis, it appears reasonably priced, potentially undervalued, with upside suggested by the DCF.
Okay, now the flip side. The key bearish points, the bear case.
Well, there's the near-term cyclical downturn, declining year-over-year revenue, cautious guidance, that heavy revenue concentration in automotive, and the significant external threat from those potential 2025 U.S. tariffs.
Which could raise costs, dampen demand, and is amplified by their China exposure.
Exactly.
Yeah.
Plus, the CEO transition, while planned, still introduces execution risk. And that consistent insider selling, with no open market buys, is a definite cautionary signal.
Okay, so recapping the valuation summary from the DCF model.
Our educational model estimated an intrinsic value range of $240 to $275 per share. That range tries to balance the strong long-term fundamentals against these very real current cyclical and geopolitical risks.
And comparing the current share price to that range.
NXPI's current price of $211.45 is trading at a notable discount, even to the lower end of our estimated intrinsic value range.
So that suggests a potential margin of safety.
For long-term, value-oriented investors with patience, yes. It suggests an attractive entry point could be forming, given the company's quality, durable advantages, and shareholder-friendly policies.
But, and at a big but, those material bearish risks shouldn't be underestimated, right? Tariffs, auto downturn, CEO transition.
Absolutely not. The current valuation seems to reflect a market that is cautiously weighing these significant near-term headwinds against what look like bright long-term prospects. What really stands out to you here, balancing that quality against the current turbulence?
That's the crux of it, isn't it? How much do you weigh the undeniable long-term strengths against the very real short-term storms?
Precisely. So as NXP navigates these currents of cyclical downturns and geopolitical shifts, the real question for you, the listener, is how much value do you place on an undeniable moat in critical, evolving industries versus the immediate turbulence that tests even the strongest of companies?
A great question to ponder. And that wraps up another deep dive. We really hope we've helped you cut through some of the noise and get better informed on NXP Semiconductors. We love helping you find those aha moments.
Just remember, this deep dive was powered by advanced analytical tools, and it's purely for educational purposes. It should definitely not be considered financial advice.
That's right. Please do conduct your own research or consult with a qualified financial advisor before making any investment decisions.
Always good advice.
Until next time, keep digging for knowledge.